So, afternoon, everybody. As I said at the beginning, you may or may not have caught that. I'm Mel from Big Society Capital, going to be your host this afternoon. My role at Big Society Capital is as Senior Director for Social Sector Engagement. What that really means is talking to social enterprises and charities about what social investment is and what it isn't. And we've run a number of these Let's Talk Good Finance events. I'm actually celebrating my 6th anniversary with Big Society Capital this week. I can't quite believe where that time has gone. But Let's Talk Good Finance was created as a response to when I first joined Big Society Capital. It seemed to me that if you wanted to find out about social investment, you needed to be prepared to travel to London from wherever you were in the UK, pay quite a lot of money for a train ticket and probably an entrance ticket. And then you'd have lots of people talk at you. And I do remember sitting in lots of big audiences and conferences and thinking, I really just want to chat to somebody who's done it and ask them some of the questions. And one of the things that when we run these face-to-face sessions, perhaps in smaller groups, we always ask people why they've come. And I always distinctly remember, in fact, I'm sure I've seen somebody in the chat say they're from Nottingham. So it was one of these events we did in Nottingham. And I asked the audience why they come, and a lady said, I've come to find out what the social investors won't tell me. So that's Siva and Adrian, that's obviously not you. But basically what we find from Let's Talk Good Finance is what people value most is to hear from social enterprises and charities who've been down this route before. So they can share the sort of warts and all, not the polished version, the good bits, the bad bits, the bits that they weren't expecting, but also the story of how they've used repairable finance to support their organisation. So I'm delighted to say this afternoon we have a great lineup for you. So our Hear From a Peer sessions are going to include Tara, who's the founder of V22, of Siva from Head of Arts and Culture at Nesta. They're going to present together. And then we're going to hear from Paul at Tees Music Alliance, presenting with Adrian, who, as he's introduced himself in the chat, is the lead investment manager at Key Fund. And then Anushka and Simon are going to talk about Stretford Public Hall. So we've got a range of different types of investment, different funds, perhaps smaller ones, larger ones, and also community shares-based investment. So a real range. I'm going to do a little bit of introduction before that about what is social investment. We will have at the end of the Hear From a Peer panel, we will have Q&A. That's where I was saying to everybody, we were really keen for you to use this opportunity to do exactly that I described you before in Let's Talk Good Finance, is to ask your questions of the Hear From a Peer speakers. And you can just jot those into the chat facility. Please jot them as you think of them. We'll keep an eye out for them and we'll make sure that we come back to them as well. We're then going to have a little comfort break, give everybody a chance to nip off, either get the it always says virtual refreshments, but that doesn't mean that you have to, somebody said this in our prep, you don't have to pretend to drink a cup of tea, you just have to can go and make a refreshment or pop out to your own facilities. And then we're going to come back and do a social investment update, which give you a little bit more context about what's going on, and also we have a great case study resource pack to share with you. It's also fair to say that we're going to be using a couple of different forms of technology. We're going to do some live surveys with you using something called Mentimeter. If you're struggling with the tech at any time or to follow the pace and you want us to slow down or help you out, please again do post in the chat and we'll make sure that we do that. And then right at the end, we've got some optional networking, which basically means if you decide that you'd like to follow up with somebody and talk a little more detail, or you've just got some general questions you didn't have a chance to answer in the Q&A, then you have the option to stay along at the end. In terms of housekeeping and ground rules, I believe we're posting those in the chat. And I think other than that, we will move on to the next section. Okay, so the first thing we're going to do is we're going to do a little Mentimeter. This is a live questionnaire, and you'll need another piece of technology for this if you can, either on your phone or a laptop, or you can actually, if you can manage between Zoom, you can start up another browser, and we're going to use something called menti.com. So you've got a couple of different ways that you can do this. You can either scan the QR code that's on the screen in front of you, or you can just go to menti.com and then it should ask you for a number. We're just posting these also into the chat. So you go to menti.com and then you will, or you can use the direct link that's now been put in the chat, or you can scan the QR code, multiple ways to get to Menti. And then you'll just need to type in, if you're going to Menti, you'll need to type in the code 85570379. It's quite a long one actually for Menti. Okay. Emily, you're going to share the Menti screen? Is that the plan? Yeah, okay, great. So we are asking you to rate your social investment knowledge as it is at this moment in time. So if you put in the code, is the login code in the, you've got the direct link there, might just be worth popping, Annie, popping the code in as well. Yeah, can you give the code again? I knew that would be one of the, I think it was, have you got that, Annie? It's 8557 and I can't remember the last four numbers.
Yeah, I can't remember the last four numbers. I'm just finding it.
Oh, it's at the top. It's at the top of the screen. Sorry, on it. It's 85570379. There we go. And so what we're actually going to speak about is why you've come to attend today's Let's Talk Good Finance. We've got a whole range of things here to try and get better options of understanding of the options. I love this one. Have a good old dig around the subject area. That's really good. Lots of the things that you've got in here, we will share the results of all the Mentimeter polls that we're doing so that you can understand why everybody else has come here. But it really is, lots of the things that I'm seeing here in front of me speak very much to this type of event, bothly to get the peer experience, to expand our knowledge. For a long time, there's been an awful lot of myth around social investment. And also to have the opportunity to ask questions as well. Lots of diversification of income. That's also another real key one. And lots of business planning. Okay, great. So we'll move on to the next one. This is the rating that I ask you to do. So on a scale of 1 to 10, how would you rate your knowledge of social investment at the moment? So 1 represents no knowledge at all, and 10 represents very informed. You can answer whatever you like. It's only an aggregated score that comes up. So be as honest as you like. I certainly wouldn't put myself, even after 6 years in the expert category, I still learn a lot every day. But it's really helps, I think, for the speakers to have an understanding of how well informed our audience is, and then that gives us some idea as to where we should, what sort of areas we should cover and where we should pitch the information. I do also always ask audiences to call us out if we get to jargon or too financy. I'm not actually sure whether that's a word. Then please make sure that you let us know in the chat, and we'll always explain any acronyms or jargon or that we tend to fall into. Okay, so we've got about 33 responses on Menti at the moment. If anybody else was still looking to get in there, you can go to menti.com and use the code 85570379, and then you put in. But it looks like at the moment we're around about 4.9, so about midway in terms of understanding of social investment. And our aim is that during this afternoon we can try and work through this and discover a little bit more together. Okay. Right, so we're moving back to slides. Great. Okay, so what I'm going to do now is just for about 10 minutes or so is just to talk to everybody about what is social investment. So if we have a number of us and our average scoring is about 4.9 or about 5 out of 10 currently, I think it's always a good place to start, just to make sure that we're all in the same place about exactly what is social investment. Can you just move on one for me, Emily? Thank you. Okay. So I always like to say there's good news and bad news around the role of social investment. So all of you won't need me to tell you that social enterprises and charities are dealing with some of the most challenging issues in the UK. So the good news, if you like, is that social investment works wherever you happen to be based in the country. So whether you're on the outer highlands of Scotland or right down in the sunny coast of Devon and Cornwall, social investment isn't restricted by geography. There are some investors who have focuses on issue areas or geography, but it can work for any organisation across the UK as long as you have an income or a revenue stream and are able to articulate how you might repay the money. Because I suppose if you want me to get to the bad news, and just to be absolutely clear, social investment is the use of repayable finance to help an organisation achieve a social purpose, which in my very blunt Midland terms is it's money that you have to pay back with interest, usually with interest. Okay, so just three quick stats for you. When surveyed, and these stats come from either Charities Taking Charge, which was an MPC piece of research, or SUK State of the Sector, Capitalism in Crisis. When asked, 31% of charities said that more funding was the most important tool to help the sector increase its impact. Over a quarter of charities have set up a trading subsidiary as they look to diversify their income streams and look towards more commercial models. Some of you put that in the previous Mentimeter. And around 43% said access to finance is the biggest obstacle to sustainability and growth. And that will include grants, but also looking at debt and equity finance, which are just some of the things that you can access through social investment. That was all contextual before this big thing that was called the pandemic that has been with us for over the last year. And it felt important to acknowledge that the stats that I've given you before have been further impacted. So last year, it was estimated that there was a 10.1 billion funding gap. The incomes were expected to drop by 6.7 billion, and essentially there is ever more need for our services. And I know for many organisations, particularly those that are servicing heritage, culture and the arts, the continued lockdown and restrictions and social distancing and the way to be able to recover income has been increasingly challenging. However, there has been huge growth in the social investment market, and I think certainly I've seen in the last 6 years since being in this sector, the variety of products that you can access have changed. And it's also probably well worth saying that, again, from the Social Enterprise UK's research, is the average need for a first-time investment in this sector is around £50,000. And what we always describe that we want is patient. So we want time to get our business models up and running, affordable, not always cheapest, but affordable, best value capital, and risk bearing, because often the things we do are not without risk. Okay, so I think the easiest way for me to demonstrate to you how does social investment work is to play you this very short, just over a minute long video. It's an animation and it tells you what is social investment, and it does it in a much better way than I would do describing. So we're just going to play that for you now.
Sorry, that's my fault.
I know you were so seamless in transition, and I know it's just that little sound button to tick, isn't it?
Yeah.
Across the UK, charities and social enterprises like yours are tackling some of society's biggest problems. Maybe you've set up a coffee business to give people the skills to get back into work, or are running a nursery and using the profits to support local parents. Whatever your mission, you'll need money to help with cash flow, to grow your organisation, or to buy an asset like a new building. You might even need finance to kick-start your new venture, and that money could come from traditional grants or donations, or as a loan from your local bank. One option is to get that money from a social investor. That social investor could be an organisation or an individual, and you can borrow their money or offer them shares in your organisation. But what makes a social investor different? Well, they don't just want to see a return on their investment. They want to see their money being used for good, helping you to keep delivering your social mission. Sound good? To see if it's right for you, check out goodfinance.org.uk.
Lovely, thank you, Emily. I have to say you're doing a grand job. I was thinking about switching between all these screens and everything. I always find it quite a challenge when you're trying to do the hosting as well. So thanks for that. So just before we hand over to the main event, usually when we ask people to give us some feedback, they always say that the hear from a peer speakers are the best slot. So no pressure speakers, but essentially people don't want to hear from me, they want to hear from you. We've established that social investment is money that you need to pay back with interest. We've established that it is one of the, we tend to use this toolbox analogy. So it's one of the tools in your toolbox. It's about understanding when social investment is the best option for you to use. So it could be alongside grants or contracts or donations. And it's also really important that you have the opportunity to have enough knowledge to make that decision. So I often get people ask me, is it worth it? And that's a question that you and your board, if you have a board, need to answer. And we hope that by exploring the resources on Good Finance and by hearing from the speakers, you'll be able to ascertain whether looking at social investment is the right source of funding for your organisation. I'm sure this is going to be a recurring theme that we'll come back to during today's event. But with 2 minutes to be on time, we're doing okay. I'm definitely giving that 2 minutes over. I'm going to hand over and we're going to start off. We call this our Hear from a Peer slot, the warts and all journey to social investment. So I think what the lady in Nottingham that I shared with you before, what it means is people don't just want to hear the polished version of what perhaps you think that somebody will tell you from their professional opinion. They want to know what it was really like. And I'm really delighted this afternoon we've got 3 sets of speakers that are going to talk about their journey. So let's kick off. We're going to hand over first of all to Tara, who's the founder of V22, and then she's going to co-present afterwards. We're followed on by Siva, who's the head of arts and culture at Nesta.
Hello. I shall just get right in. So yes, my name is Tara Cranswick. I'm the founder and still the director of V22, which is a shared ownership art organisation, which consists of a collection of contemporary art and affordable workspace and studio offering across 10 buildings in North and South London. Previously, we hosted a series of events, exhibitions, and public programs, and we hope to do so again. And we run 3 public libraries in partnership with local authorities and local communities. V22 started in 2005, and we've tried almost every business model and governance structure. We enabled our shared ownership through the stock market for many years. We have a private company limited by shares, which runs the studios, a not-for-profit, which has run our events, and a charitable incorporated organisation, which runs our libraries. And it seems a bit excessive, I know, and we are trying to simplify it, but we struggled to find a model which represents what we want to be, which is profit-making in the sense that we're sustainable, secure, not reliant on funding, or the founders' acceptance of lower wages in order to build their dream. But at the same time, making a positive impact in the world in which we operate, and not just through charitable giving or CSR, but in the everyday meat and bones of what we do. And when I started V22, I wanted to make a profit, not a big one, but for the reasons outlined previously, and because I wanted to pay my staff a decent wage and one day make a decent wage myself. And artists move studios so often. We're in substandard buildings awaiting development. 3 to 5 years is what you hear all the time. And for me, profit meant security. It meant we could get a mortgage, we could get a long leasehold, buy a place. But in the affordable sector, it's pretty hard to make a profit because you're affordable. A catch-22, which the bank representatives I've spoken with never really appreciated. So I figured that if we could just have more buildings, although the margins were small, if there were enough of them, we would make a profit. And so V22 grew. We took on more buildings and we added more zeros into the figures coming in, and we added more zeros into the figures going out. But that was about it on the positives. And on the negatives, we lost touch with our studio holders, with our artists, with what we had set out to do in the first place. We were growing and chasing security at the expense of doing a good job and at the expense of enjoying our jobs. And the bank managers still didn't get it. We owned our first property outright before they gave a mortgage on it retrospectively to us. And so we started looking elsewhere, started looking for the people that might understand our business model, that might understand that if you added up all the discount on our studios, then we actually funded the arts to quite a staggering amount. That affordability meant a 100% occupancy rate, that what we made happen was more than just the figure on our profit and loss. And I was not new to the idea of impact investment and social investment. V22 had been part of the social stock exchange right in the beginning when it still hoped to be a proper stock exchange. And the founders had introduced me to some excellent people who'd been working on social capital, impact investment, investing for good. And I hoped there might be something for us, but at that time it was very much just institutional investment. And then I was at the Nesta offices for something else, and I'm afraid I can't remember what. But I was looking at the little coffee table in their waiting room, and it was full of Nesta reports and flyers. And one was that they had just announced the first awardees for round 1 of their Arts Impact Fund. And one of those awardees was Bow Arts. And a little light went on for me because it meant that they understood the artist studio sector, what it did and what it meant. And so we applied for round 2. We specifically wanted funding to purchase a 125-year leasehold of Orpington Priory. We'd won the right to buy it through a tender process with Bromley Council, and we were successful. And we borrowed £300,000 at 5% for 4 years, which is short, unfortunately. The lucky thing with a mortgage is that you usually have 15 to 20 years to pay it back. So you're not immediately chasing profitability once again with getting your building up and running. But hopefully I'm dropping that hint in the right place. Luckily, we also had the time in which to apply, as the process is long and extremely thorough, but also surprisingly helpful. Siva, who you will meet, was with me throughout, usually alongside another colleague, but it was Siva who did a thing which almost no one had bothered to do before. He took the time to understand our business model, why we had chosen it, and how the intricacies worked. And along the way, he also pointed out its weaknesses and strengths. And I actually learned a great deal about my own business throughout the whole process. And I'm not sure that he meant that as part of the process. He was just very good at due diligence, but it was extremely helpful. And the ongoing relationship has proved equally helpful. We have learned to look at the things we do and measure the good we do. And it's a great feeling to do that and to write it down and to be able to say it. we got into quite serious financial trouble in 2019, and I went straight to Siva and explained everything to him. He understood the risks we'd taken to grow, and he understood why, and he and the Arts Impact Board have been very supportive. And still in my regular catch-ups with Siva, it's a bit like speaking to an expert on my own business. And with COVID, of course, everything has gone on longer than expected. And Nesta have been incredibly supportive throughout. And so Emily is going to share my slides for me and show you the building that we purchased. It's grade 2 star listed. The oldest parts are from 1290. It's one of the few rectories to have survived the Reformation, and it's set in beautiful gardens, which are also listed. There are later editions, literally through the ages, and the latest one is from the 60s, which is the former library, which is lovely in a very different way. And it had been empty for a number of years, which you don't want for any kind of building really, but definitely not for a medieval one. And it was on the Heritage at Risk Register. And now the buildings house 28 studios and 47 studio holders. And I suppose the journey has brought me to a place where I've given up on my old ideas of profit. Some of the gifts of COVID for us have been to reconnect the V22 management with our studio holders, to reevaluate what we do and why, to seriously judge the time we spend doing what we do and whether that is justified. And armed with the knowledge of our impact over years, chasing money, even if it is to secure so many good things that we do, is just too costly. And so I believe that the role of social finance must increase, and the role of good finance, I hope, is here to stay. And I do think that we live on the cusp of a world where people will speak of impact with the same importance with which they now speak of profit, and will define success in terms of what we do, equally with what we make. And we won't have to speak in negatives anymore. I've always hated not for profit. Maybe one day we'll be able to say for impact. At least I very much hope so.
Great. I think I've just been unmuted. Thanks, Tara. Loads of kind words there, and you know, it's been a great kind of relationship, and I think your organization's come a long way. You've come a long way through all of this, and it's been a real pleasure to work with you and learn about what you're doing, and obviously getting through COVID, which has been something that nobody has really foreseen. So yeah, I'm sure a lot of people in the audience can probably relate to a lot of that story and what you've said. So I'm just going to share my screen. Here you go. I hope everybody can see the slides. Yeah, I've got a few slides here about, I guess, arts and culture finance and what we do and our open funds at the moment. We're a specialist team at Nesta that provides social investment to arts, culture and heritage organisations. We've been doing this work at Nesta since 2015, and our first fund, the Arts Impact Fund, which E22 borrowed from, has provided over £7 million of investment to 27 organisations in England. We've supported a range of art forms and business models, from music venues to museums, from theatres to dance companies and everything in between. Building on that work, we've raised 2 further funds, which I'll talk about shortly, and we're continuously working to improve the financial resilience and social impact capabilities of not only for our borrowers, but for the sector at large. On our website, you can find detailed information on all our funds, as well as in-depth case studies of every investment that we've made to date. So just to outline who we are as people, we're a small, hopefully approachable team that takes a very collaborative approach to working on new deals. We have a diverse set of professional backgrounds, from working directly in the arts and culture sector to the creative industries more broadly, to banking, finance and strategic consultancy. I think what unites us is a keen interest in the arts, both in the day job and outside of work. Incidentally, this microphone right here that I'm using right now was purchased for a DIY music project, but don't worry, there'll be no performances today. So next, a bit about our process. It's pretty straightforward, really. So on our website, there's a brief application form just to give us, your contact details, essentially. We'll then have an initial conversation about 30 minutes long to learn more about your organization, its activities, history, and what it needs the investment for. And during the course of that conversation, we'll assess eligibility, whether you meet the eligibility criteria for one of our funds. If we think that's all positive, we'll then request some information, more in-depth information on your organization. So any business plans, financial information, any information relating to impact. And we'll start to build up a picture of what your organization is about. It's kind of an iterative process with lots of Q&A back and forth, and hopefully meetings in person when those can resume. If we think that we can prepare an investment application for one of our committees, we'll then write that on your behalf. So there's actually no application form really for you to fill in. The only thing that you as kind of an applicant will need to do is provide us with timely, kind of accurate and clear information that we need to do our work. Our investment committees meet quarterly, and they have the final say as to whether a deal is approved or not. So just before talking about our funds, on this slide, I wanted to give you an overview of how social investment has been used by some of our investees. So you've heard one particular use case from Tara there and B22, but as you can see from this slide, perhaps, social investment can be used for a wide range of purposes, from paying staff to investing in new equipment and infrastructure, even buying property. And in the last example on this slide, in the case of underwriting, what we mean is that a finance facility can be made available that you would only draw down if you needed to. So as a sort of safety net if certain activities don't go to plan. A bit like an overdraft facility that you can only draw down once, really. And I'm happy to talk more about specific examples of use cases of social investment in the Q&A. Naturally, in all of these cases, there needs to be an operating model that can repay the money borrowed, as social investment is not a grant, as we've already heard, and nor is it a replacement for grant funding. So it's not going to be applicable in all cases, but where it is, I think it can be a pretty flexible financing tool. As social investors, we look at business plans, financial models, and the case for impact in the course of making our investment decision. And I can talk more about our due diligence process in the Q&A at the end. So next, onto our open funds. We've got two open funds at the moment that together offer lending of between £25,000 all the way up to £1 million. The first of these is the Arts and Culture Impact Fund, which provides investment of between £150,000 all the way up to £1 million, with that investment being repayable by June 2030 at the latest. So roughly kind of a 9-year term. This is a UK-wide fund supported by partners including Arts Council England and the Heritage Fund. As with all our funds, we try to take a case-by-case approach to looking at the opportunities that come across our desk, and we can be quite flexible in terms of how we structure the deals. The interest rate that we charge is dependent on our perception of risk and the availability of any security. For the larger loans in this fund, or those that are capital or property project related, we'd normally try to take security if it's there. For smaller loans in this fund, so anything less than £250,000 perhaps, those tend to be unsecured as they're more to do with growing a business and testing new activities. Our second fund is the Cultural Impact Development Fund. This lends on a purely unsecured basis and on a smaller scale, so £25,000 up to £150,000. It's open to organisations in England only. And since the pandemic, we've also been able to offer grant funding as part of the total investment package to help organisations invest in smaller assets for longer term resilience and things that will help them to kind of bounce back following the pandemic. In this fund, we're also experimenting with incentivizing the achievement of social impact targets by giving discounts to the interest rate if those targets are met. So trying to introduce a genuine trade-off between financial and social returns here, which I think is social investment is ultimately what it should be all about. This fund has also got some criteria around what service users we expect applicants to work with. So I'd really encourage you to look at our website for more details on all of that. So yeah, that's kind of everything from me, really. I'm just going to take the slides off and very happy to take any questions on any of that in the Q&A or later. Thank you.
Hello, I'm Paul from Tees Music Alliance. I'm going to spend the next 10 minutes looking at my watch, looking at my notes and trying to look down the camera as well. So if I'm not looking you straight in the eye, that's the perils of Zoom technology, unfortunately. So we are Tees Music Alliance. We're a social enterprise constituted as an industrial provident society, and we were registered back in March 1986, so we've just done 35 years. And our purpose in life is to support music activists, and music activists are promoters, artists, technicians, event organisers, and we also develop audiences for each of those music activists. We operate a collection of buildings, and if our slide could magically appear, I don't do slide sharing just yet, but we'll see our slide coming up and give you an indication of our buildings. We've been fortunate to be given 3 listed properties by our local authority, Stockton-on-Tees Borough Council, and they all reside within its designated cultural quarter, and all 3 buildings are within 6 feet of each other, but we have 3 separate postcodes, 3 front doors, and 1 letterbox where hopefully all the mail turns up. We've got our main venue is the Georgian Theatre, very boringly named, but that name is stuck, and believe it or not, it's a theatre that dates back to Georgian times. It's actually the UK's oldest surviving Georgian theatre, and before we got our hands on it, it had previously been a Salvation Army citadel, a boiled sweet factory, and latterly it had become the home to a kind of an old age pensioners coffee morning venue. We came in 1993 and returned it to use as a music venue. And you can see that the top row of slides there show the external of the building, and the building when it's been absolutely jam-packed for an event, which is a situation we hope to get back to soon. Our main sources of income pre-pandemic were about 40% grant funding and 60% earned income. And that earned income predominantly came through ticket sales, room hires, and our bar sales. The grant funding came from a mix of trusts and foundations, but primarily our local authority give us core funding, and we go back to the Arts Council around about once a year for project funding. And our route to social investment came about following a refurbishment to our theatre. So our theatre pre-2017 held 200 people, and it was quite a scruffy, although the name makes it sound a lot grander. We don't operate it as a theatre, it is a music venue. It's a sweaty black box full of people jumping up and down with a predominantly loud indie band at one end of the building, but it was bursting at the seams. We didn't have enough toilets, we didn't have enough bar space. So when the opportunity came up for a hotel which was adjacent to the theatre, had fallen into dereliction, the local authority bought it and spent £1.5 million refurbishing it, knocking the two together to give us a lovely space that can now hold 300 people. We've got additional bar space. We've got lovely toilets, and we bang on about our toilets because the number of toilets dictates the amount of people we can fit in the building. And for 2 or 3 years, we were kind of going all guns with events and a range of other activities. And it was those other activities that brought us to social investment, really. When the building was refurbished, it brought about a great deal of interest from the local community. So we were getting lots of requests to do birthday parties, weddings. The local business community wanted to do lots of social and kind of corporate events, and we were being run ragged. We weren't advertising any of these, but we were finding that we didn't want to turn down the additional income, but B, we were having to switch from our kind of event organising head into a party planning head, and in my case, kind of an overall sort of fundraising, making sure the building was functioning. So I could come off the back of a day where I've been chasing plumbers for toilet repairs. I've been getting battered by people wanting to sell me cheaper electricity, and then I'd have to come down with a smile on my face and host a party of 100 people celebrating somebody's retirement or other, and paint a smile on. And it was wearing a little bit thin. So we identified in our business plan when we reopened that we really needed another person in the organisation that would deal with the more business focused activities, looking at our supply chains to see whether we were paying the going rate for utilities, looking at our bar to see whether the profits were as they should be, and also looking for new business. So encouraging more of those parties, but leaving the rest of the team to get on with the music development. So we'd actually been approached by a local funder who wanted to help us with that, but after a year of being led down the garden path effectively, that relationship broke down, and we were scratching our head as to how we could actually fund this post. So someone in our local VCS umbrella organisation suggested that we should consider social investment as part of a three-pronged approach to finance, alongside grants and earnings. Our trustees adopted that as something we should look upon. So I was tasked with going away to research what the opportunities were for social investment. I made one phone call to a colleague in the neighbouring town, and they recommended getting in touch with the Key Fund. So I dropped the Key Fund an email, and Adrian got back to me very, very quickly and soon put me in touch with Brian, who is our kind of point of contact. We went through a relatively short in terms of what we've been used to in terms of application processes for funding, which can be anywhere between 3 to 6 months. We went through a short but very kind of intense period of mutual sounding out, really. And at the end of that period, we were very pleased to have been accepted as a likely candidate for social investment. And the theory behind the investment was that we'd be able to service the loan through the additional business that we were pretty confident of generating. So we were offered a blended loan, a blended package rather, which was 42,000 loan and 8,000 grant, which we used to renew essential business computers. And we're paying an interest rate of around 6.5%. So everything was fine and dandy. This is early 2020. We started advertising the post, and we got to a point in early March 2020 when we were going to start to interview people. And I'm scratching my head to think of what happened in March 2020, but something horrible did. So we're now in a position by March where we're completely shut down. The top right picture in our slide is that room full of people bouncing up and down. 300 people, all with money in their pockets, using our bar. They've all bought a ticket. It's a lovely transaction. Everybody's happy. They've had some great entertainment. We've put some business through our tills. Fast forward into October last year, which was the first opportunity we had to reopen. after lockdown 1 and after things looked like they were getting on the feet again. And the bottom middle slide there is our 300 capacity venue, stripped down to 55 capacity, all seated, table service only, and obviously everybody is getting bathed in hand sanitizer as they walk through the door. So a very different environment, and you know, one that was obviously extremely challenging. We've kept going. We've really valued the Key Fund's relationship with us, and that relationship perhaps came into its own during lockdown, where Brian, our main point of contact, was pointing us towards particular opportunities that the Key Fund were involved with, and we were delighted that 2 of the 3 opportunities that we were signposted towards, we were successful in drawing down grant funding, which kept us going for well, up until now really. So it's been a really close relationship with the Key Fund, and dare I say it, a relationship that we wouldn't have had with a high street bank. So just to finish off, the last year has been a massive learning curve, but we've, you know, the overall takeaway that we've got would be, you know, stick with things and hold your nerve. We're keeping it to our original plan to employ a senior staff member, although that may be tweaked a little bit following lockdown. But you know, we're raring to go, and we're waiting to reopen when the green light is given.
Fantastic. Right. Over to you then, Adrian.
Right, good afternoon, everybody. Glad to see everybody here. I will just share my screen. Just bear with me one moment. I'll try. Does everybody see that now? Cool. Good stuff. So I'll do a whistle stop on Key Fund and what we do generally, and I'll try and keep to Mel's rigid timescale so I don't get into trouble. So Key Fund is a social enterprise, and we provide support both on a one-to-one basis, as Paul was mentioning there, and financial support for a number of organisations, basically from the Midlands up to the borders of Scotland, so anywhere in England within that patch. Unfortunately, we don't go down to the south, the southeast, the southwest. And what we do is we help and provide that support to incorporated organisations, which include charities, social enterprises, and cultural organisations. So we've supported organisations ranging from alpaca farms to theatres to architectural digs, you name it, we've been there. Nothing's really off the table. Funding from ourselves generally is up to about 150,000. And the vast majority of that is on an unsecured basis. So we provide anything from 5,000 upwards to that 150. So we do big, we do small. It's on an unsecured basis, as I say, and it's for any purpose really, with terms of up to 15 years, depending on the purpose and where you're based. The fact that it's unsecured means we don't ask for guarantees generally from those involved in the organisation. So they don't have personal liability. We lend it to the organisation, not to the individuals running it. And alongside our investments, we generally put a grant in of anything up to about a third. Now that'll probably upset Paul a little bit because it wasn't a third when Paul took his funding from us, but it has now been increased up to a third generally. So there's a good amount of grant funding that we can put in, and it can be for any purpose really. And the loan is obviously for the balance. What I want to do really, rather than go through terms and what have you, is just to give you a bit of a feel for the sort of organisations that we funded. This is not representative of them all. It's just to give you a feel for the sort of sectors that you're working in. So I'll quickly run through what we funded and why. So the first one, top left, is Rosehill Theatre, based in Cumbria. We lent funds to them and put some grant funding into them over a 10-year period for both capital expenditure for things that they wanted to buy, some equipment, website renovation, and also some revenue, some cash flow expenditure for marketing and for working capital. So a bit of a mix there in terms of the purpose. Bottom right is the Factory of Creativity, based around Manchester. We funded them over a 10-year term again. We gave them a 3-month holiday in terms of repayments of the capital. So what we do is we set the facility up in order to meet what the client wants. So in order to get established, we can tailor down the cost of the borrowing for a period of time to enable them to get set up so that they can start getting the revenue in with which to repay it. And the Factory of Creativity, we put money in for working capital, some sound, some lighting equipment, and to upgrade their seating. Bottom left there, Art B&B, that was, as you can see probably there, it used to be a hotel, a big bed and breakfast that closed down. The local authority wanted to see it open again and part of a cultural event. So we put some funding in there over a 5-year period to refurbish some of the rooms and a lift for disabled, plus a bit of cash flow, where artists could go and spend time doing their work and staying in the premises at the same time. A few more examples. The Exchange Theatre in the Northeast, we funded them over a 5-year term for working capital, tiny bit for capital spend, but in the main it was for working capital for cash flow. Docks Beers, on the right hand side there. Now that was an interesting one in that it was a brewery essentially providing beer to the trade, but there was no large venue space in their location in Grimsby. And as you can just about see above Docks Beers there, they had an upper floor which wasn't being used. So we put some funding in there over a 10-year term for them to set that up as a venue gig space for up to 350 people. And that is now, I would suggest, probably the largest event space in the town of Grimsby. And in the bottom left-hand corner in Barnsley, Lamproom Theatre, we put funding into them over a 5-year term just to renovate their bar area. They had a bar, but it was a bit higgledy-piggledy. They couldn't maximise their income during breaks at the bar. It was too crowded, so we refurbished the bar, or we funded the refurbishment of the bar so that they could increase capacity and therefore improve their income stream. So they are just some examples of the organisations that we've supported. But as I say, it is far-ranging, so nothing is off the table. We can fund the vast majority of purposes, from anything from 5,000 up to 150,000. So give us a call if you want to talk about it. Obviously, the other examples are Tees Music, which we've just heard there. Details of what we can do are on our website, which is thekeyfund.co.uk, and there is an application form there also. Just give me a call. My details are there if you want any more information or just to kick things around and chat things through. In terms of timescales, from an application coming in, we usually turn the funding around within about 6 to 8 weeks. So the funds are usually in the account within that period. And anybody interested in rates, it starts at 3.5% up to 6.5%, somewhere in between there. I put on there as well Creative United. We've done a lot of work with them via Prosper North. They've done a lot of work with cultural organisations, and they've provided some significant support to that type of organisation. So I'm always an advocate of them, and I would always suggest that if you want some additional support and help, they would be a great organisation to contact. Very, very quick whistle-stop tour there, so don't get into trouble off Mel. Any further information, Q&A, send me a message, whatever, and we'll pick it up from there.
Hello, hi. I'm just going to share my screen as well. So hopefully that will work in a second. Yeah, so I'm Anushka, and I'm going to be talking about the history of Stretford Public Hall and how we took ownership of the building. And then I'm going to hand over to Simon, who's going to talk about our community share offer that we led. So Stretford Public Hall was built back in 1878 by John Rylands, Manchester's famous philanthropist and first millionaire. He built the building for the people of Stretford, and it's proudly stood right in our town centre since then. It's got lovely features still maintained today, and it's a great grade 2 listed building. For about 70 years, it was used by local people in all manner of ways. It was one of Manchester's first libraries, was used as meeting space, and for about 30 years was home to Stretford Children's Theatre. It had an eclectic mix of speakers ranging from Enoch Powell to Tony Benn, hosted early Rock Against Racism gig with The Fool and a young John Cooper Clarke coming over from Salford. And yeah, it's sort of been a proud part of the local community. For about 20 years, the council used it as council offices before they realised that it was basically falling a bit into disrepair. Wasn't the best place to be having offices in, and very expensive to run. So in 2013, they announced that they were going to dispose of the building, and we're looking at ways of doing that, including selling it on to private company to turn into probably flats or something along those lines. And that's where I got involved, myself and a couple of friends who had literally no idea what we were getting stuck into, decided to start a campaign, and naively decided we were going to take on the building. We spent a good year and a half convincing the council that we did know what we were doing, with lots of support from organisations and from a wide range of people in the local community. We got together a business plan and put in a bid to demonstrate how not only would us taking ownership of the building provide sort of community benefit for Stretford, but also sort of ramp up the local economy as well, and change Stretford's perception of sort of a bit of a dead end place where nothing really happened, into making it a bit more lively and attract outside investors. So 2014, they agreed to sell us the building for the princely sum of £10, which to this day I've never actually paid. And yeah, we took it on. So they gave us the keys. We didn't have a clue what we were doing, but we luckily had lots of people locally come in and help us, and managed to, with the help of about 500 volunteers over the course of about a 6-month period, get the building up and ready. Lots of free pro bono support from local people, and also some grant funding from our local housing trust. We got our first tenants in as our artist studios. The MP rented space from us, and we ended up creating a co-working space. So good form of steady revenue from basically anchor tenants. We started up wellbeing classes, low cost, affordable stuff for the local community, from sort of yoga, dance classes. We got community cinema going. This is when we showed cars and did a bit of a creative little thing, getting the kids to make all their own cars. Set up a local choir, community choir, and had a whole range of events throughout the years. Got Stretford Children's Theatre back and running again, thanks to much to the delight of the sort of local kids, and all was going tickety boom until you know, obviously we, as everyone else, we had a little bit of a hiccup last year. But actually, interestingly, that's kind of brought us new opportunities where we've managed to work more on providing. We became a mutual aid centre, working alongside the council, and have now started running census support, and kind of increased our focus into more frontline work, and been, you know, it's actually been some benefits to this terrible time. So we've paid through it all from a variety of ways. The revenue funding, the revenue streams that I was talking about earlier, through events we've run and through the for our tenants, we're pretty much getting to a point where we're looking to be sort of relatively self-sufficient. Obviously things have changed a little bit, but we're still doing okay. But predominantly for capital works, we've relied on a mixture of grant funding, a loan, and community shares. I'll let Simon talk a bit more about the community shares, but I'll just step back and talk a little bit about the governance and why why actually it worked really well for us to go down that line. When we took over the building, there was, a small group of us who were board members. We set up a board, and we had lots of volunteers, and it was working really well. But one of the biggest things was trying to find a way that the volunteers felt that they had a voice talking to the board, that the board felt that the local community could really get involved, and that, we could find a way that felt that the ownership wasn't just a small group of friends who had taken on, but actually a wider way. And we came to the conclusion, after trying various different outfits, that a co-op was the way forward. And we became a community benefit society of a charitable nature, which gave us the tax benefits of a charity, but also meant that we could have a real meaningful way the local people could have membership and have a say in the way in which we were run. And that kind of fits in quite neatly with the community share offer. So one of the biggest areas of the building that we needed to set up was the ballroom, and get, we worked out that this was going to be a few £100,000 to get renovated, and the traditional grants were hard to come by for that sort of large amount of money, and community shares seemed like a really positive way forward. So I'm going to hand over now to Simon, who is going to tell you a bit more about that.
Thanks, Nish. I'm going to now try and take over screen sharing. If I do this, can everyone see that? Oh, is that working? Yeah, cool. Yeah, so so essentially, I think Anushka kind of brought me into the fold about 2016, and I was living locally, knew about the hall, but I hadn't been involved. But there'd always been this, I suppose, as Anushka said, a strong passion to involve the local community, and getting people to actually have a stake in the organisation through community shares was always sort of central to the plans. So in 2017, we kind of set about trying to raise funds to renovate the ballroom, because our business plan was predicated on the idea that we could refurb the ballroom and basically generate greater levels of income from a mix of events, from weddings to gigs to theatre performances to community activities. But we needed to essentially improve both the quality of the ballroom, but actually improve the structural integrity of it and get more people in the space. So we essentially started planning a community share offer. And the key thing is that we were essentially putting an investment proposition to our local community, which I suppose was underpinned by two key documents that kind of form part of that. So it's your share offer. So this is the ask. What are we looking in terms of investment? But it was underpinned by a business plan. So the idea was that we'd run the figures and realised, with this investment, what we could expect to see over time, which would then allow us to pay those community shares back to our community over a long period. And that is the key thing, that it is a very aligned, patient form of finance, where the sort of financial proposition is fairly limited, but we knew that there were people that were willing to invest with us. The other key thing that really helped us is we applied for this thing called the Community Share Standard Marks. You can see the little mark there, which basically meant that we got a community shares advisor to help us make sure that our share offer met best practice around community share offers. So in terms of what we were looking to raise, we were fortunate enough to get support from the Community Shares Booster Programme, which it's still running and is still offering funds, and actually I think specifically for heritage projects at the moment. So this essentially meant that we could sort of boost our community investment by securing institutional investment through the booster up to £100,000. So we essentially sort of had three targets, and a lot of community share offers will have these targets. So we had our kind of optimum amount. That was the amount that we felt would best position us in terms of doing the work we needed to do on the ballroom renovation work. And that was 250,000, of which 100,000 would come from the booster. So essentially, we had to try and secure that other 150,000 from our community. We did think we could probably get away with 200,000 and scale back some of the work or try and secure other funding. And as with any old building, we knew there was lots of work to do on it. So if we could raise more, we could definitely put that money to good work. So, so those were our targets. We had a share offer launch in February 2017, 2nd of February. So there's Anishka presenting to our community to convince them this was worth investing in. And we then sort of had a sort of campaign to raise the funding. So we did a video appealing to people to invest. We put a banner, we went around, we did community events, and we made good progress in the first couple of weeks. I think we raised about 30,000 within week one. But we started to see a bit of a tail off in the middle. So I think with less than a month to go, we had only raised less than 100,000. So we were less than halfway, and we were all feeling pretty worried and concerned that we weren't going to get to our minimum, let alone our optimum. But we did a big campaign, a big flyering campaign across 10,000 households across Stretford, a number of events, and we got some really useful local media coverage from the Manchester Evening News, to the point where we got to a week to go. So that was from the 25th of March, and we just only had 50,000 to raise at that point. And yeah, by the I think it was the 31st of March or the 1st of April, we had raised £255,000 in 56 days. So that came from just under 800 investors, of which the overwhelming number of those were local people, so 790 local investors, which raised 126,000, and then we had 7 organisations who also invested alongside the community, all on the same terms. Obviously, our big investor was Coptage UK, which is the investor in terms of the Community Shares Booster, but we also had the Architectural Heritage Fund, Trafford Housing Trust, and some local businesses as well. So in terms of the kind of range of, just in the coverage of the investment. So Stretford is the M32 postcode, and about 2/3 of our investors came from that postcode, but actually the majority of other investors came from neighbouring postcodes. So it was a very locally driven share offer. So 87% of our investors were in the sort of, I would say, sort of 2-3 mile radius of the hall. And, you know, that was amazing that we were essentially building investors and membership from our local community, who are now will have a say and an involvement in how the hall is owned and run. And in terms of the kind of breakdown, again, the overwhelming majority, we set a minimum investment of £100, and the majority of investors came in at that level. So we had 656 investors who invested between £100 and £200. However, we did manage to attract some slightly larger investors, which did really help get us to the target we needed. Our largest investor, community investor, invested for £4,000. So that gives you a sense of the breakdown. But the average investment was at £160, and actually we offered a kind of instalment scheme, and which was really well received. So about 1/3 of our investors invested through instalments, so paying £25 over 4 months, and we felt that made it more accessible to people that might struggle to find £100 in one go. So yeah, a key thing has been that the community share offers levered in much more investment for us to do the work. So as with all these things, as we started doing the ballroom renovation, we uncovered more costs and needed to do more work. But the community share offer levered in further grants. So overall, we've raised over 400,000 of additional funding. So over £500,000 has gone into the project. And in terms of what that looks like, we've just finished the ballroom renovation. So we've now got a really amazing space that not only looks great, but is structurally sound. We've increased the capacity through remodeling the fire exits. We've got new toilet facilities. We've improved the heating and ventilation, lighting, 2 new bars. And we also unlocked 2 other rooms underneath the ballroom. So we've got additional spaces as well, which again, we hadn't anticipated doing that, but because we had to do work on the floor of the ballroom, it meant that we could also bring other spaces into refurb other spaces. So it's been really an important lever to basically to improve the offer in terms of our space and basically increase our trading activity by having really credible spaces. I don't know if I'm going over time.
Yeah, I was
got
just
a couple more slides.
Simon,
oh, have you? Sorry.
1 minute. Come on, because I need
1 minute. Okay, cool. So yeah, so just in terms of the terms and conditions of our share offer, so we'd committed to 2% interest on the shares from last year. We actually offered interest 1 year later than planned, but because we hadn't finished the work, and we felt it wasn't right to start paying investors before, but we had no opposition to that. Our shareholders completely understood. We have offered interest this year, but actually most have indicated that they're going to forgo interest altogether. So they're happy not to get interest. Others are happy to have their share interest credited. So, our payback for this year is limited. We are starting to allow people to withdraw their shares. And our share offer indicates that we can release about 70% of shares each year. And one of the key things that we're doing is working towards what's called an open offer, which basically means we can bring new investors in, which will help us allow more people to get their investments back if they want to. But I think the key thing is, most people are happy to stay investors. It's very patient. People are willing to kind of be involved for the long term. So I think that's my minute gone. So I'll stop there.
It seems a really good place to actually move into Q&A. I've got some great questions. So for all of the panelists and speakers, thanks very much to all of the audience for putting your questions in. I'm going to try and direct those now to some of our speakers, and then Emily will remind me if I've missed anything. But actually, you just started to cover this piece really nicely for us, Simon, which was about setting out all of the different places that you got money from to be able to do this. So we've had a couple of questions, one with the angles around grant funding and the other around how you generate income. So let's do the grant funding. Quite a lot of questions from the audience here about whether having other sources of grant funding is a benefit or a detraction. Does that impact on taking on investment? Siva's very helpfully given some feedback on that in the Q&A. But I just wondered if anybody, Paul, I wonder whether, or Tara, whether, in terms of your organisations, have you accessed ranges of different types of funding? I've certainly heard other organisations talk about this, but I just wondered if either of you wanted to comment on that.
We have received funding for our not-for-profit and our charitable incorporated organisation, but the social finance actually went to our just regular company limited by shares, which, I mean, I don't even try really. There's so little grant funding available for it, which was why this was so useful.
Okay, great, lovely. But I think, yeah, you're starting again. I think the picture is building here. Paul, you came off mute, so let me go to you next.
Yeah, it was just about grant funding. We tend to use grant funding specifically for one-off projects as we kind of move through various phases of activity. So we, and we use a range of different trusts and foundations who may have an offer that we can tap into alongside organisations like Arts Council England and local authority where appropriate.
Great stuff. Adrian, were you going to come in there?
Yeah, I was just going to say it can work in a number of ways, really. From a lender's perspective, it can de-risk the lending because the more money that goes in from other sources, the easier that becomes. Secondly, it gives a bit of confidence because the grant funder will have done some form of due diligence themselves. And the other side of it, the benefit to the organisation is often with these things, it's an organisation putting the head above the parapet first. So if you come to a social funder and you gain some funding from ourselves or someone like us, then sometimes that can unlock other funding along the line because other funders will do the same as us and say, oh, well, if Key Funds looked at it, it may be all right. So we will now look at it. So it's sometimes a bit wrapped up in that way, but it can be beneficial, yes. Yeah. And also you can use our funding as part of the match funding if that's required as well.
Okay, great stuff. Anushka, yeah, you're going to come in?
I was just going to add there, and I agree with the, a range is really useful for bringing in other funding. But as a word of warning, don't try and go for funds and base your project around a fund. Rather, make sure that the fund fits what you actually want to do.
Absolutely,
great. Doing that.
No, great piece of advice. Siva, before I wrap this one up, is there any other investment that you've made? I think I can think of another one of yours, but is there any other investment you've made where, again, Nesta Arts Impact Funding has gone alongside other range of grant funding? Because we can't often see this, don't we, in large heritage projects?
I mean, I think when we're involved in a capital project, there's almost in all cases is going to be grant funding alongside. Capital projects tend to be large in nature, right? By definition, almost. You're talking hundreds of thousands of pounds minimum, more often than not in the millions of pounds. We have rarely lent the entire amount. So normally there's other lenders or certainly grant funding. If it's a charitable organization. So for example, we've recently supported the development of a new talent house for youth music and urban culture in Stratford and East London. That's currently being fitted out, due to open later this year. There's significant grant funding that's been raised to deliver that project, and we're just kind of plugging the gap because they're still fundraising. And that's kind of representative of lots of projects that we supported.
Okay, great. And I think I would probably just bring this question to a close by saying that, yeah, it can be a challenge, I think, if you've got lots of small pots of grant. And I think Anushka's absolutely right. If you are trying to tick everybody's boxes, that can be a lot of resource, and also it can be quite challenging. But we often find in these very large heritage or cultural capital projects, so I'm sort of thinking of something like Clevedon Pier or Wigan Pier, which isn't a pier, or I'm trying to think, there's another, I thought it was a Nesta one in Wigan. Do I want to say another Wigan?
Yeah, the Old Courts Theatre in Wigan.
The Old Courts Theatre, that was the one that I was trying to remember, or Bramley Baths, that you often find large amounts of grant. And as Adrian said, we hear this a lot, that sometimes grant funders are assured it can sort of make the difference, if you like, because knowing that you will have been through due diligence, that your business model will stand up to repayable finance, that can often give grant funders additional level of reassurance. And also grant funders are particularly looking to sustainability for their money, so these can often help. So it's definitely worth looking at a balance, and it certainly isn't, it won't necessarily put a funder off. So you can mix and match these things. I'm going to bring to the second point of this question then, which was about the ratio for lending. So again, we've had a few questions around, how does a social investor balance, if you like, where people get their income from in terms of making lending? So I quite often get questions about, will investors consider me if I get some of my money from grants, some of them from donations, some of them from trading, some of them from contracts. So, and again, Steve, I know you'd put a little bit of that in the chat, but Adrian, did you want to pick that one up, and then I'll come back to Siva?
Yeah, absolutely. As all of us are responsible lenders, it's only right, and it's right for us, and it's right for the organisation to make sure that we're all comfortable with affordability of that facility or the debt side of that facility. It wouldn't be right to provide debt funding to an organisation where affordability could be in doubt. So we will include in our assessment any income that we can reasonably agree will be forecast or could be generated. Perhaps if it's a new venture, it's what you think will be generated from future trading activity. And we will also include grant funding where we are comfortable that that grant funding is in place, is agreed, or perhaps there's a letter of intent from the funder to agree it. What we sometimes get is a large slab of grant funding in a cash flow forecast, and when we ask the client, they say, oh, we are going to apply for that. Well, we can't include that in affordability assessment because, you know, it might just get instantly rejected. It might never come off. So we're looking on including those levels of income that are reasonably assured, I would suggest, and that can include all sorts of income. Okay. And if you're in a grant fund from an organisation where you've had it for the last 10 years, then again, we might take the view, well, the likelihood is it will be paid out again this year if that's what the client thinks. But if it's very speculative, we will ask the client to remove it from the cash flow for safety reasons.
Yeah, thank you. Siva, anything you want to add to your comments?
No, other than we don't, you know, sometimes it can be a bit unhelpful when we say, oh, it all depends, but it really does, you know, there are so many different situations and we look at everything on a case-by-case basis.
Yeah, I think it's worth saying that the other thing that I think is really important for the audience to understand is that not all investors do the same thing, and investors have different risk profiles depending on where they get their money from. So some investors might be prepared to take a proportion of grant income, you know, a higher proportion of risk. Say, for instance, if the capital they're lending to you is philanthropic at source, so they don't have to pay it back to somebody else, they might be able to take a bit more risk. If it is a social bank, essentially doing you lending on a secured building, they might be able to take a bit less risk and might not be prepared to take grant funding or donations. But it is all about this piece we talked about. I love the piece around that Tara was talking about, due diligence. I haven't found many people that have enjoyed it. Again, just one person that I've met so far. Weirdly enough, she was also from Nottingham, but a different time. There's something about Nottingham, isn't there? But I have heard, and you said this, Tara, actually, I was going to come to you on this, that you said that, you know, you felt that the process was really useful and helpful and got you to really understand your business. We hear that a lot as well in due diligence. But can we just go back a little bit to about the relationship you have with your investor? You talked about it not being like that with a bank. And again, I'm just probably keen to explore that a little bit. And we heard that a little bit through Paul's experience as well. And I'm keen to pick it up on the community shares issue. So yeah, Tara, your relationship working with an investor.
Well, I mean, in every way, it was better with the bank. We've dealt with a few people from the bank, and I mean, I used to, as a joke for a while, call it my failing property business, because they would literally kind of look at me and say, right, so you own or manage 10 buildings across London, and you're not making any profit pretty much. And I would be, yep, that's right. And it would just, there were so many questions. The process took months and months and months, literally, for them to understand our business model. And it's not that complicated. You know, it is artists that are mostly our tenants, but it's a straight lettings business. You know, and this wasn't to take out a mortgage to buy a new building. This was borrowing against a building which we'd already managed to buy. So, and you know, and by the end of it, I don't think they ever got our business model. Whereas Nesta was the complete opposite. That was the first thing they wanted to do. That was the first thing that they did. And once they, and I didn't have to explain it in terms that, you know, might be understood in other spheres. I thought that was very, very useful.
Sure, sorry, you're glossing over all the questions that I had about the ownership structure and the and you know, all the art collection.
Well, you looked as if you were taking it all in, Siva.
Great. So in fact, we've got a couple of quite specific questions. I also wanted to let the audience know we're running slightly behind, but I think we're doing so well with the Q&A. I don't want to sort of break it, so I'll just delay the break slightly if that's okay with you. Let me just go. I've got a really sort of specific question just for individual speakers, so let me just try and deal with those. Paul, there was one question for you specifically about the acquisition and ownership of your building, and I think that probably speaks a little bit to asset transfer, but can you just very quickly answer that for me? And it was about you know, whether the local authority gave you the building for free. Was it a structured asset transfer? Did you have to buy it? Was it refurbished? You know, just a couple of minutes on that would be, or a minute or so on that would be great.
I probably made it sound over generous, but we lease the buildings on a peppercorn rent, so no money changes hands. We've been in them since 1993, and the buildings were of absolutely no use to the local authority previously. So our part of the bargain is that we animate them with activities and events, and we contribute to the local economy. So yeah, gave is probably a bit glib. We lease them on a peppercorn basis.
Okay, fantastic. I think that really helps, because I know we often get into this, and I know Nushka, you touched a bit on this about when the building came up. But I've got a couple of questions that are specific, therefore, now to you and or to community benefit societies and shares, and love it when I've got a panelist asking a question as well. So that's really good. Thanks, Eva, for that. But let's one specific governance question. We'll go back to governance in a minute about. Is it the CBS, the Community Benefit Society, that's what it stands for, a long word, that actually owns and operates the building and the services, or is there a separate entity involved?
We're pretty simple in that the organisation owns the freehold of the building, and it's the organisation which our community become members and investors of. So while we work with partners on some of our activities and services, in terms of the kind of ownership, we just have one organisation. And I think there's an element that I think the simpler you can make it, the better, because it just means that people understand, you know, community shares is already potentially something that people have to get their head around, because it's, you know, it's different to a conventional share. It's a little bit like debt. So, you know, if you're adding other elements to it, it can sort of make it a harder kind of proposition for people to get behind. So
you perfectly winged into the next question for me then. It was like a seamless. So what Siva basically has asked is around the community share issue model, and feeling like many of us do, that it can be particularly helpful for organisations in the arts, heritage and leisure, often where there are venue or buildings based, and hopefully when you can harness the community. Although actually you could extend this to, you know, I know I have community shares in a community land trust, for instance. How can what would be your top tips? I have a couple each, just on times. How can many or organisations try and do what you did yourselves, and how they can be supported to do so? So, a couple of things from each of you would be great.
Do you want to start?
Yeah, I'll start. So first thing is to get people to really understand the simple message that they're investing, not donating, and that as a result they get some meaningful say in how the organisations run. And then getting people to talk to each other, to you know, really get people infused, and to, you know, or I would say I know at least 300 of our investors personally, and they all probably know each other for a little spider web. And I think people talking to each other and infusing people about the project and explaining about community shares was the sort of the way that we got the message across, alongside the other advertising and stuff.
Yeah, for me, it's probably being as open and transparent and honest about things, because there's, you know, you are essentially, you know, the organization is sort of co-owned by your community. So there's no real benefit in trying to be inward looking and insulate, even when things start, you know, go wrong, which they will undoubtedly will go wrong. And the key thing is to just be honest. Like, tied ourselves up in knots about, you know, the fact that some of our ballroom work was taking longer and other things were coming, and we were, you know, worried about how that was going to be perceived. But, you know, the key thing is just to explain, you know, what's going on, and people are amazingly supportive and patient and helpful and will actually help you. So yeah, just be as open about things as possible, because you'll be surprised how much people are willing to just support and be patient.
Okay, fantastic. Thank you very much. I feel like there's so many more questions. So I was just saying that we'll, I'm sure Simon will be over this shortly. We've got a few things left to cover on the agenda. I was going to give a little bit of an update, but I'm going to cut that down to just a couple of minutes, and then we can send you some things afterwards. And then we wanted to sign off with a Mentimeter, which is because we're really keen to get some information from you and what the recovery looks like from you. What we'll do is we'll actually do that with the people who are left at the end in the networking, but we're going to send it out to everybody as well, so that we can capture the whole piece. So Emily, I'm just going to come to a couple of the questions that I said that I would. I did talk about this during the break for those that were there. There were a couple of questions around governance. Siva again's answered it around, you know, some investors can only invest into asset locked organisations, and others can do what we would term profit with purpose, or companies limited by share that have got social purpose or mission locked in. So you'll have to talk to the individual investor. You're able to search the investors and what they do on Good Finance. So we're going to post in the link in a minute to how you find all those investors and advisors, because it's really important to say that we've obviously featured Key Fund, Nesta Arts Impact, and how you can use community shares and programs like the Community Shares Booster program. But actually there are 56 different social investors listed on Good Finance. Some of them have particular focuses, like Nesta, who are focused on arts, Key Fund, who have a geographic focus but a much more general funder, and then you can find national as well as local funders. So it's really important actually to have a look at the full range of organisations who might be able to help you. And again, we've posted in that link to this really handy resource on Good Finance that has a relationship to all the different governance structures that there are, and how they relate to social investment. That was one of the things I found hardest to get my head around when I first turned up into the social enterprise space. Had a couple of questions specifically about tax relief, EIS and SEIS and SITR. There's a lot of acronyms in one statement for you. Enterprise Investment Scheme, Seed Enterprise Investment Scheme, and Social Investment Tax Relief. I've posted some more information in the chat. More than happy to, in the networking session, to talk to anybody at distance. SITR is my latest thing that I spend a lot of time talking about, but I'm not going to have a chance to cover it now. I was just going to come back to the question around patience and flexibility of finance. I think both Adrian and Siva have talked about how they're able to work on a case basis, but we also do hear constantly from the sector about the need for really patient capital. And I think it was Tara who mentioned this very back at the beginning. And, you know, we often see that unsecured lending is lent over 3 to 5 years, and then, you know, more mortgage-based lending, secured lending is sort of 10 to 15 years. Tara, you made this point, I think it was around you saying, you know, you lent over 3 years and you're trying to make sure that that was falling in the right place. But what does patience mean, I suppose, to your organisation in terms of generating an income? Why do you need it to be more patient?
I suppose because we hardly ever have any savings. There's a kind of a rolling cycle because we move on from building to building, because we're affordable, because our margins aren't very big. And so you take on a new building and you have masses to do. You know, when we were much younger, we would literally build and let and build and let and build and let and cordon off the construction areas from the tenants who were working over there. And luckily we're now in a position where we have the savings to build and then open the doors. So you have to have patience. It takes a while to do it. It takes a while to let it. Does that sort of answer the question for us?
Melanie, sorry, you're muted, I think.
How did I manage that? Siva, sorry, you came off mute. You want to say something?
Yeah, no, just so with our Arts and Culture Impact Fund, our bigger fund, that now lends over a longer period because we recognise that actually, it's actually quite hard for many arts organisations to repay 150k even, over a period of 4 to 5 years. But I think so patience, I think, is about length of repayment term and the affordability that comes with that. But it's also, I think, about the lender willing to kind of tolerate changes to the plan, and being flexible. And obviously a big test of that over the last 12 months has been, that which shall not be named. I think a lot of investors, a lot of social investors have really looked at their portfolios and thought, okay, what can we do? Can we delay any capital and interest payments, for example? Can we restructure our loans? And so there's been lots of conversations, I know, from my peers in the sector with our investors to say, look, what repayment flexibility can you give us that we can then pass on to the loan?
Yeah, and it looks like it's so connected here, because that was perfectly timed for me to just press enter in the chat. And this question I get asked all the time about how social is social investment. I think the pandemic really helped us to understand that. So I've posted a blog that I wrote the end of last year. Let's just quickly whiz back to Anushka and Simon on the, you talked about the community shares in terms of, how people could potentially decide to take their interest or not, and how they can withdraw their money. And this is one of the real benefits that we often hear talked about with community shares, is the fact that it's a sort of it is repayable finance, but it's sort of between that long term. It's almost like it comes with the same sort of motivation often as a grant or a philanthropic investor, but there are other options. So yeah, how did you sort of factor in that patience to your business model?
Yeah, I mean, I think we were always aware that, and again, I think from the beginning, which Anushka will, that there was such a strong passion collectively to see the building not only saved, but realize its full potential, that that we knew that people were willing to contribute. But I do feel that it's really helped to demonstrate our professionalism and our kind of competency to say, look, we are going to treat this as an investment. We are going to work hard to pay this back and really think about our business model. So I think that discipline is actually helpful for us, because it makes us kind of really think about how we can ensure that the hall is we can have a viable business model. I think the other aspect is because we've got the booster, so we've got Co-ops UK as a big investor, and they are interested in getting their money back, maybe on a slightly quicker timetable than maybe our other community investors. And so again, we can sort of balance that as well.
And there's a level of accountability as well with community shares, in that you feel this need to keep business model moving in a way that will make you profitable, which in the long term is good for the project. But also, just walking around the streets when I walk the dog, or in fact the builder in the back garden is one of the investors right now, and you do feel that level of accountability to them, that that you've done what you can to make sure their money's protected, whether or not they ask for it back, because the fact that they've actually invested in you is quite humbling.
Great. Okay, lovely. And then my final question in this section, before we get to our sort of wrap up and then how all organisations are actually feeling, is Paul, you talked about your board and getting the board comfortable. This is something we often hear can be challenging. How did you go about that, and did anybody else have any experience with either resistance from board members, or having to get board members comfortable with what is essentially taking on debt or a liability, or at least an investment that you're responsible for? Paul?
Yeah, I think the important thing for our board members was that any investment that we tried to secure didn't come with personal guarantees attached, because that was a big thing. if we bear in mind that our board members do what they do for love as volunteers in their spare time, they don't also want to be saddled with any associated debt if something goes wrong, you know, with the way the organisation is running. So that focus is quite narrowly down to dealing with investors that didn't ask for personal guarantees. We have an overdraft in normal times, and once that goes over a certain level, the bank asks us for personal guarantees. So we never increase our overdraft beyond the level that we've currently got. You know, and again, that's a comparison between social investment and the high street investment that we may or may not be offered.
Yeah, absolutely. Anybody else want to come in on the board point?
Our board was very worried at the beginning about not being a typical charity, because if you become a co-op, you have to not be a register with the Charity Commission, but register with the Financial Conduct Authority. And there were a lot of concerns that we wouldn't be able to access funding, and it has proved a couple of times an issue. But I think funders moved on with the new type of charitable companies, and kind of that quickly got less of a worry.
Fantastic, thank you all so much. Emily's just posted in the chat there. If this is a challenge we find often, we've got some great stories and case studies of organisations that, you know, have really struggled. And so one of the things that we did is work with a range of again, peers. So these are all charities, social enterprises, community benefit society, directors, board members, trustees who've taken on investments share their stories, and there's a range of free resources that you can find on Get Informed Social Investment for Boards. So thank you to all the speakers. You've been amazing. I'm not only trying to keep on time, it was just the fact we had such a rich discussion that we ran over slightly. And I'm going to just try now and summarise, if that's okay. And so what I'll get Emily to do is just share the last bits of the slides. I would also say we've still got some networking time after we wrap. So if with the actual formal part, if you want to stay to chat to any of the panelists or speakers, you can still have a chance to do that. But what I'm actually going to do now is just share a couple of reflections, and also we have prepared for you, because we know one of the things that hearing from peer speakers does is make some of this relatable. So I think Emily's going to share the slides for me. She's put together a really great little animation or a GIF that I can speak to, and we've prepared a range of case studies for you. So some PDFs of a whole different range of case studies that show how people have used social investment, whether that is for buying an asset, for kickstarting their organisation, or for growth and innovation. So I can see this was one of those that when Emily first sent it to me, I said, oh, it's just a blank slide, but it isn't, I can promise you, when it plays. That will be great. Yeah, so I'll let you just look at the words as I talk. We wanted to showcase just a range of different organisations. We've heard from music, we've heard from arts, we've heard from heritage-based organisation. We've also got community TV. We've got performing arts organisations, dance theatres, and then music. Yeah, great case study and podcast from HQ Recording, who work with street and grime and rap artists. So there we go, a different type of music genre. And then some more heritage organisations like Gorton Monastery, which again, there's a great video case study that accompanies this one. So what we'll do in the follow-up is we've put these all into nice one handy pack, and we hope that means that this will be very relatable, and hopefully you'll find an organisation like yours. One of the things that I really like is that you can tend to always find an organisation like yours, and we're very generous at sharing. So I'm going to finish up here with the 7 lessons learned. These come through absolutely every Let's Talk Good Finance that we run, but I think we've covered most of these today, so I thought this would be a great place to just wrap up. So number 1, social investment is not benevolent money. We've talked about the fact that you have to repay it back with interest, but we've also talked about the level of flexibility, the understanding. I used to get asked this all the time, how does a social investor demonstrate it's social? Well, I think it has been during the pandemic. It has been about the flexibility. And I'm going to skip very quickly then to impact matters. So where with a grant funder, you need to meet the grant funders' outcomes. A social investor won't tell you what they want you to do with the money, but they will want to know what difference their money is going to make. So impact does matter, and that doesn't mean that you need lots of glossy reports. What you have to do is decide what you're going to measure. You need to value, measure what you value, and make sure it's proportionate, and then tell your story, whether that's in numbers or in people's real life stories. So we always say there's no stories without numbers and no numbers without stories. With number 3, it's about much more than the money. You heard this from Tara. You heard this from Paul when they were talking about the fact that, the relationship with the social investor, I've heard this so many times, spans so much more than just borrowing money, whether it's for advice or for networks. We have a lovely little clip from an organisation, coaching organisation that borrowed money from Big Issue Invest. And during videoing, the chief executive said, I thought that I was going to get a faceless banker, and instead I got you. And I think that really tells the story that the relationship that that social enterprises and charities who borrow from social investors have. So it's about much more than the money. Honesty is always the best policy. Again, we heard that today. When things don't go according to plan, which they don't, then it's really best to go back to your investors or the investment organisation. Again, we heard this from Stretford. Talk to your investors. Don't bury your head in the sand and think that you can just front it out. Tell them what the issue is, and social investors are really used to this. And also, the last thing that a social investor wants to do is to put your organisation out of business, because it stops you from creating the impact. So they will definitely work with you. We didn't have one today, particularly about price, which is quite unusual. We were around affordability, and thank you to everybody for sharing more about the terms of their loans. Social investment isn't always the cheapest form of finance, but I do think sometimes it's about not comparing apples with apples. So we often talk about base rate or mortgage rates, and we're often not talking about that type of lending. But it is fair to say that depending on the type of lending that you're taking on, or the investor and their risk appetite, there is a range of investors. So it is always best to shop around and to find out who is the best investor for you. Due diligence isn't fun, but it does make your business better. We definitely covered that one. And the other one, which did come up, it always takes longer than you think. So borrowing money, it is important that you get comfortable with it, the investor gets comfortable with it. And it certainly isn't something that you're going to turn up tomorrow and say, yeah, I need £50,000 by next week. 6 to 8 weeks is a fairly quick turnaround. It's definitely the other top tip I would give you is ask the investors that you're talking to what their processes look like. Some people are able to act much more quickly, others have longer sort of lead times. The other thing is that social investors collaborate and work together. So it's quite acceptable and usual practice for people to, if one investor can't do all of the lending, or it's not quite in their risk appetite spectrum, they might work with somebody else. So that's it from me in terms of the 7